So, I mean, having said that, the three criteria of this selection, what are some of the red flags of REITs that
that we can take note of.
Yeah, correct.
Okay, let me start off with one simple one to warm things up. Okay, so instead of talking about the red flag directly, let me phrase it into an action that we can take to go about identifying any potential red flags. But this one is more for retail sector.
Okay.
So what we can do is we can get out into the shopping malls and observe. Okay, what to observe? First thing we can observe is the traffic flow. So is the traffic flow heavy or not? The shopper traffic. Like for myself, I'm someone who don't like to be in crowded places. But if the malls that are managed by the REIT that I invest in tend to get very crowded, then I should be very happy about it.
That's for sure.
Correct. On the other hand, if let's say you go to a mall and you see that it's very empty, look like one where you can go and shoot some action movie, run about one, right? Then that is a potential red flag.
If it's a ghost town, you
like
should run away.
Correct. So that is one thing that we can observe. The second thing that we can also observe is the occupancy, also the vacancy. So are there many empty shops that are still not taken up by the brands or not? That is another thing that we can see for ourselves, the occupancy inside the retail mall.
Correct.
On top of this, the third one is we can also observe the shopper behavior. So when shoppers go to this shopping center, right, do they usually go to this mall just so that they want to go to that one or two brands? Like, do I go to this mall because I want to go to FairPrice only, but I don't want to go to the other shops? Or is it a case where most of the brands are doing quite well? Customers are walking in and out of the shop because that will make a difference. If it's the first case, right, it means to say that the REIT is not bringing in the brand offerings that matches the needs and the demand of the shoppers. So eventually the tenants won't do well. The tenants won't do well, the REIT also won't do well.
Correct.
So these are some of the things that we can observe ourselves and to identify whether there are any potential red flags. So these are very simple, non-technical actions. And it's good that it's kind of convenient as a consumer ourselves. We can actually look at this from our consumer perspectives. But at the same time, I must also caution, although it's convenient that we can do this, right? But we should also avoid putting in too much consumer perspectives in when we're looking at our investments. Because sometimes we may end up falling in love with an investment idea. Because we like the brand as consumer. Like for example, I may like to go to Wisma, I may like to go to Ngee Ann City to shop, but I may not be as interested to invest in StarHue Global REIT.
Why is it so?
Okay. So why is it so? Is because if you take a look at the revenue and the net property income, which we mentioned earlier, for StarHue Global, it has been on a downtrend for the last 6 to 7 years. So in between 1 or 2 years got increased a bit but overall the trend is still a declining trend, and I don't like it that there's no good track record for the financial performance, the financial profitability of the REIT. So which is why I think we need to maintain a balanced view, balance out between our consumer thinking caps and also our investor thinking caps.
Correct.
So while it's good that we can look at an idea from a consumer perspective, but at the end of the day, we still need to fall back on all these hard financial statistics.
Yes, that's
to help
correct.
us
That's
make
correct.
our investment decision.
We don't just look at this. From the point of view of our eyes and but we also have to look at
not enough.
Correct. If you see like the financial statements, like the revenue and net profit falling in consecutive quarters and consecutive years.
And
that's something to be careful about.
Something is wrong.
Correct. And at the same time, the debt, the aggregate leverage, which I talked about just now, is heading up towards the regulatory level of 50%. That's also something that we need to be mindful of.
Correct. So another red flag that I have, this one may come as a surprise for many investors is, this is not a definite red flag, but a potential red flag, which is overly high or overly attractive dividend yield. So this may come as a surprise, right? Because oftentimes investors they are seeking for the higher the dividend yield, the better.
And then you just jump right into it.
So why do I say that this is a potential red flag? You see, in life, sometimes when things look too good to be true, it's better to take a pause and ponder and analyze the situation before we embark on the idea. So why does that mean? First, explain what is dividend yield first. So dividend yield is calculated by taking the dividends per share divided by the share price of the REIT.
Yeah.
So it is telling us how much dividends we're receiving relative to the share price. So on the surface, it may seem that, so that means the higher the dividend yield, the more dividends I'm receiving. But that is not necessarily the truth, because there are times where the dividend yield gets inflated due to the falling share price, and not because the REIT is paying more dividends per share. In fact, the REIT may not be paying us more. So in such a situation, that's actually not beneficial for investors.
Yes, that's correct.
Actually, we are losing out in terms of capital losses on our underlying shares in the REIT itself, right? And the deeper implication is this. Now, if share prices have been falling for a long period of time or an extended period of time, why is that so? Is it due to some temporary headwinds, or is it due to some changes in the fundamentals of the business of the REIT?
Yes.
If it's due to the changes in fundamentals, then that would have even more far-fetching implications on the revenue, on the net profits of the REIT, and that will then affect the dividends that we receive in the future. So this can actually become a potential red flag. Not a definite one, but potential one. So the next time when you see that, wow, this REIT is giving a very attractive, overly high dividend yield, it's better to analyze the REIT first.
Don't jump right in before doing your own research. Based on the criteria that we looked at just now.
So under the current high inflationary environment where interest rates are rising, investors also find themselves in a difficult position where they do not know if they should still be investing in Singapore REITs, or should they be looking at alternatives like some of the popular ones are like treasury bills, Singapore savings bonds, and so on. So what's this concern that investors have under the current rising rate environment?